The stock market has just reached a new all-time high. And naturally, a question comes to mind. We are dealing with nearly $36 trillion in national debt. There's ongoing tension in the Middle East. Oil prices have crossed $100 per barrel. Inflation refuses to go away. Banks are cautious. The Federal Reserve itself seems uncertain. And almost every expert online is warning about a potential crash. So why is the S&P 500 still hovering around 7,100 points as if everything is perfectly fine? That's exactly what we're going to understand today. More importantly, we'll break down the four invisible forces that are silently holding this market up. Once you understand these, you'll never look at market crash coming headlines the same way again. Here's what most people misunderstand. The market isn't supposed to make sense right now. In fact, based on headlines alone, it should be falling. But markets don't crash just because things look bad. They crash when certain key systems break. And right now, those systems are still functioning. Barely, but they are holding. This system has been evolving for years, and today we're going to break it down step by step. No complex jargon, no finance degree needed, just a clear explanation of how this machine actually works and what could eventually break it. Let's start with the obvious concern. The United States is currently sitting on approximately $36 trillion in government debt. That number is almost unimaginable. If someone started counting to $36 trillion at one number per second, it would take more than a million years to finish. At the same time, geopolitical tensions pushed oil prices above $100 per barrel, levels not seen since 2022. And oil doesn't just affect fuel. It impacts food, shipping, manufacturing, and even healthcare. Inflation, which the Fed spent 2 years trying to control, is slowly creeping back again. And yet, the stock market continues to rise. The S&P 500 hit around 7,137 points in April 2026, a record high. The Nasdaq also touched new highs. At first glance, it feels disconnected from reality. But instead of being broken, the system is actually being supported by hidden mechanisms. Since 2008, four major forces have been preventing deep crashes. Let's break them down. First force, the Fed put invisible safety net. In simple terms, the Fed put is a belief, not a law, not a guarantee, but a strong belief that if things get bad enough, the Federal Reserve will step in to support the market. They can cut interest rates, inject liquidity, or buy assets. This belief has been reinforced multiple times. In 2008, during the financial crisis, the Fed supported banks. In 2020, they injected massive liquidity into the system. Each time, the message was clear. If things break, we will step in. Because of this, investors don't panic as easily anymore. Instead of selling during drops, they often buy the dip. Why does the Fed do this? Because household wealth in the US is around $160 trillion, and a large portion of it is tied to the stock market. If markets fall sharply, people feel poorer. They spend less. Economic activity slows down, and that can trigger a recession. The Fed tries to avoid that cycle. However, this system has a weakness, and that weakness is inflation. If inflation rises too much, the Fed cannot lower rates aggressively without making things worse. That situation is called stagflation, slow growth combined with high inflation. It happened in the 1970s, and fixing it required extremely high interest rates, which damaged the economy. So, yes, the Fed put is powerful, but not unstoppable. Second force, passive investing machine. This is one of the most powerful and least understood forces. Today, more than half of U.S. equity investments come from passive sources: index funds, ETFs, retirement accounts. Here's how it works. Millions of people receive salaries regularly. A portion automatically goes into retirement accounts like 401ks. That money is then invested into index funds automatically. No analysis, no timing, no emotional decisions. It just keeps buying every single month. Whether markets go up or down, this system continues to pump money into stocks. This creates a constant demand, which helps stabilize the market during downturns. But there's a catch. This system depends heavily on employment. If unemployment rises significantly, people stop contributing. People start withdrawing money. That's when the flow reverses. Also, a major demographic shift is happening. Older generations are retiring, meaning they are slowly moving from buyers to sellers. That reduces long-term support for the market. Third force, algorithmic trading systems. A large portion of trading today is done by machines, not humans. These algorithmic systems follow rules. If the market goes up, then they buy. If the market goes down, then they sell initially. This can accelerate a fall. But here's the key detail. These systems have limits. Once they finish selling, the pressure reduces. Then, when the market stabilizes, they switch direction and start buying again. This creates a rapid rebound effect. That's why modern markets often show V-shaped recoveries. A recent example, the S&P 500 rose more than 12% within just 13 trading days in April 2026. That speed is not driven by humans. It's driven by automated systems. Fourth force, options market mechanism. This one is slightly technical, but important. Large institutions called market makers handle options trading. Their goal is not to take risks, but to stay neutral. To maintain balance, they continuously adjust their positions. Here's the interesting part. When markets fall, they are forced to buy. When markets rise, they are forced to sell. This creates a stabilizing effect. During panic selling, these systems step in as automatic buyers, not because they believe in the market, but because their models require it. Putting it all together, these four forces, central bank intervention, passive investment flows, algorithmic trading options, market balancing, create a system that resists crashes. Every drop gets absorbed. Every panic finds buyers. But that doesn't mean the market is risk-free. Major risks ahead. Bond market pressure. If bond yields rise to 6 to 7%, investors may prefer safer returns over stocks. That could shift money away from equities. Inflation trap. If inflation stays high, the Fed cannot support markets easily. AI expectations. A few major companies dominate the market. If expectations around AI growth fail, the impact could be significant. Unexpected events, black swan. Things like financial system failures, geopolitical escalation, or economic shocks can't be predicted, but they can trigger sharp declines. Final perspective. Markets today are supported by powerful systems, but risks are also increasing. High valuations, inflation, pressure, and global uncertainty make the environment fragile. A crash may not be immediate, but vulnerability is definitely present. Instead of reacting emotionally, it's more important to observe key signals: interest rates, inflation trends, bond yields, and corporate earnings. If multiple factors weaken at the same time, the system could finally break. Until then, the market continues to move forward, supported but not invincible.